On the NASDAQ, I am looking for 20,000. My S&P target is 6 to 7,000. And I think the highs of this bull market will not likely be seen again for decades. Not a decade, but decades. It's possible you'll see a hike in July. I think it's very possible when we get to 6,000 or above that Powell's going to be pushing for rate hike. The rates are going to stay high for a long time. I think they use that to kind of counter the pause and try to jawbone the market lower, or at least not keep it from going higher. I think the Fed is hugely making an error in targeting the stock market. What I'm saying is that you could have a pause that lasts more than a month. It might last for a few months. It's when the melt up is almost finished. It's when we're in the last weeks of it that the Fed may tighten then and say we're hiking half a point or whatever because we see an elevated stock market. And I would call that a big error because I think it will be on the eve of a bust. The biggie is the leverage. You've got 300 trillion in global debt, and that's up 50 trillion in just a couple of years because of the pandemic. But 300 trillion globally in debt, and then of course quadrillions in notional value of derivatives, and that's leverage on the markets, all kinds of markets. So the combination of those two forms of leverage, no down cycle have we entered with anything close to this kind of leverage. And so we're in uncharted territory. The formula is really economic fragility caused by the pandemic, plus a potentially the biggest policy error in history from central banks, and plus that leverage. And you've got a formula for it takes a normal recession into something far worse. I define a bust as something bigger than a recession, not the length of a depression. It's probably pretty much encapsulated in a 12 to 18 month time period like a recession is, but it will feel like a depression because you'll see a lot of major bank failures around the world, less so in the US because of what we went through in 2008-9. So I think you're going to see more outside this country this time in terms of the banking crisis. But of course, we just saw the regional banks are fragile in different ways. So I do think that there's the potential for something quite a bit bigger than 2008-9 in terms of a financial crisis. Sure. Yeah, I don't have a number because I don't know where the upside is, but I do have a percentage. And my view is it could be up to 80%. So we had a 90% bear market in 1929. I believe the NASDAQ fell close to that. I can't remember what the exact numbers were. It was over 70 in 2001, 2, 3. So it seems unrealistic or unbelievable to say 80% peak to trough, but that's the potential. Do I know it's going to be that big? No, but I think it's going to be somewhere in that 60, 70, 80% range. And I actually think 80 is a legitimate number. That's certainly not going to happen in one cycle or anything like that. And but I think they're going to be large. I can't rule out that one of our banks, big banks, could fail. I think, overseas is much greater risk of failures. What I think is the big scenario that I think could happen is that you could have banking failures dominoing across the world all in a short period, similar to what we saw with Silicon Valley, except in a much larger fashion with much larger institutions. Once banks start failing, they fail fast. The only thing that can respond to that is money. You will see, I think the Fed's balance sheet will grow to 30 trillion or larger, and similar proportionally around the world in the central banks. During the bust, I think probably gets hit. And so let's say we get to my 3,000 prior to the bust. I wouldn't be surprised if we're back at these levels again, 1900, 2000 in the bust. obviously that will far outperform the equities if I'm right about an 80% equity decline. So it will be setting up for being a better asset going forward. But I don't think very many assets are going to be able to escape a deflationary bust. So it will be hit, and silver will be hit harder than gold because of its economic sensitivity. So silver, let's say silver gets to 60 pre-bust, silver could go back to the 20 area or 25 area certainly, and probably below that, might even get into the teens. So they'll be hit, but what comes after the bust is going to be huge. Okay, so during the bust, I think, three places: treasuries, cash, and you got to kind of pick your spots. Obviously FDIC insured accounts. I'm not at all worried that the FDIC won't be able to back its insurance. The government will fund to whatever extent is necessary to back the insured accounts. Treasuries, I believe, because as you said before, I'm looking for a 0% 10-year. And if I'm right about 20 trillion going into expansion in the balance sheet, Fed's balance sheet, you could actually see a negative 10-year. But either way, if rates where they are now, if you go from a 380, 390 10-year and go down to 0 or below, obviously that's a huge return in terms of where you feel you're going to protect yourself. And the dollar, surprisingly, I'm quite bearish on the dollar for the balance of this year. I'm calling for 80 on the dollar on DXY. But from there, I think in the bust, it's a huge, that's a big move in a short time. But in the bust, I think we can take it from 80 back up to 120 or higher, because I think the dollar will be a flight safety trade around the world. I mean, I think we haven't lost that yet. Yeah, I'd say it may even be over by the end of 24, but certainly by mid 25. I would think the bottom in the stock market might happen within 2024. Typically, market leads, as you know. So, and that describes, if we have an 80% decline, it's probably not going to be in one fell swoop. You're not going to go from peak to trough in one move. You probably have a move down, a big move down, 40 or 50%, a big bear market rally that lasts a couple months, and then another leg down that takes you all the way down. We've had this long tech cycle. The consumer obviously is going to get beat up pretty badly if we have an 80% bear market and all the other things going on, jobs and the economy down, et cetera. Housing probably loses 30% from the peak at least. So I think consumers are going to be digging out for a while coming out of this bust. What we'll see is the next cycle is going to be driven by industrial. Some of it's reshoring. We're obviously doing that now. I think that will accelerate. Some of it is infrastructure, certainly. And we'll see that. Obviously, alternative energy and electric cars, et cetera, will be part of it. But around the world, what we're going to see is an industrial-driven economy, and that demands an awful lot of commodities. We're going to have a supply-demand imbalance that's huge, and then couple that with this massive monetary infusion that leads to this, kind of overheated economy on the industrial side, and it's a perfect storm for a huge pop in commodity prices. 2029, 2030, I think you could see gold as high as 20,000. I think you could see silver as high as 400 or 500. So those are obviously huge multiples. And I also have oil going to $500 a barrel. Probably see copper. I don't have a number for copper, but it'll be many, many times this cycle's peak. And I think we see copper go to $6 this year. So many times that. When you start adding these up, natural gas will go through the roof. What we see in a super cycle is that each cycle you build more excesses. So you get bigger ups and bigger downs. You had 73, 74 was the biggest cycle in the post-World War era to that date. We had a double dip recession in the early 80s, and inflation went through the roof. Then we went through this long disinflation period, but we built excesses in the financial area in terms of leverage, et cetera. And we're coming, and then we had 2008-9. And I just think what we're seeing here is a culmination of what I call is basically a giant Ponzi scheme that's going to come apart. I view it as inevitable. Can we somehow kick the can down the road again? My only reason for doubting that is that what it's going to take to bail us out of this, call it a bust or just a severe downturn and financial crisis, is going to take even more money, and then you'll be jump starting to a higher inflation. But I don't really see a way out of this because of the excesses that have built over 80 or 90 years and have accelerated over the last 20.